All right, thank you so much. And we look like we're filling the crowd. There's still some seats on the right and left for those standing in the back. But I'm really excited about our panel right now. How do I exit and what happens next? I think particularly at Disrupt and particularly at TechCrunch, we talk a lot about growth and building startups and going for the stars. But at some point, all startups exit. They either get acquired, they go to the public markets, some go bankrupt. And the part of the discussion today is to start talking about how do you start to think about exits? When do you start to think about it? When, as a founder, do you start to reach out to investment bankers? And so I'm super excited to have three founders on stage. All the way on stage right, Mike Marquez runs one of the leading boutique investment banks here in Silicon Valley, which is Code Advisors, which was started 10 years ago, has run dozens and dozens of M&A deals and financings, and has done more than $100 billion of transactions. Thank you so much for joining us. Next, we have Justin Kan, CEO and founder of Atrium, a law firm for startups. Formerly, Justin was at Y Combinator. And finally, we have Jess Lee, partner at Sequoia, and formerly the founder and CEO of Polyvore. Thank you so much for joining us. So I want to start with you, Jess. You exited your company, Polyvore, a couple of years ago to one of our many parent companies, Yahoo. When did you start to think about exit opportunities in that context?
So to be honest, I thought about it too late. I thought about it when it was time. And I think the lesson I took away from that, which was, what happened to me was I realized it was probably time. And so I started to spin up these conversations. And I didn't have all the relationships I needed in place. And so the advice that I would give is, as founder, as CEO, part of your responsibility is, you have to set the vision for the company, you have to set the culture and the team, and you have to make sure you don't run out of money. And part of not running out of money is having those options, right? So having, just the same way that you build relationships with investors, you should spend at least a little bit of time building relationships with partners who could eventually become potential acquirers. Mm-hmm. I think being known to them, and so that time when you need to have that phone call is not the very first time you've ever had that phone call, which is kind of what happened to me in some of the in some of my conversations. I would say you need to start doing that earlier. It's not like a huge part of your responsibility, like you shouldn't spend a ton of time on it, but a little bit of time up front investing in that longer term relationship is really important, because I think while it is a transaction between two companies, it's a transaction between two people, and people care about buying a team and the people that run a particular company, and it's important to have that relationship not be completely cold at the moment when you need to have a transaction.
Perfect. And as a reminder to the audience, if you'd like to ask questions, this is an interactive panel. Open up the TechCrunch Disrupt app. We're in the How Do I Exit and What Happens Next panel, and you can ask questions to me, and I'll look at this iPad, assuming the Wi-Fi still functions. Mm-hmm. But Justin, going to you real quick. So you both exited several companies, and now you also run another startup. How do you think about exits now with Atrium?
Well, I haven't sold a company for a long time, so this might be like last year's textbook. But before, I would say like in my, so I started this company, Justin TV, and then eventually it turned into Twitch. And we ended up selling Twitch to Amazon for a lot. And I think that in those early days, I actually think I had the opposite experience of Jess, where we thought about exiting like too much. We were very desperate and thirsty. And we really wanted to sell the company at a certain point when we were about maybe 3 to 4 years in. It was like we were very fatigued. It was not going so well. It didn't look like it was going that well. It looked pretty flat. So this is when we were just in TV. We were like, we should try to sell the company. And so we were desperate. We were so desperate we got into this conversation with Google, and they were kind of interested, and we just let them interview our entire team, which you should never do. And we like clearly wanted, and then eventually they were just like, your team's not good enough and we're not going to do this deal. And then the second time around, we ended up 4 years later kind of going back to the well with Twitch. It was a completely different scenario, because we were, like the company was doing much better. Actually, it was growing. We had like a really strong community. There were very strong network effects and community effects now. And things were looking a lot better. And so my lesson there was really like, the best way to sell your company is to actually build a good company, not to like have a dog shit company and like desperately try to sell it through some, I always thought there was like some formula or something. But actually just focusing on the company was the best thing that we could have done.
Perfect. And Mike, I think you might actually be one of our first active investment bankers ever on stage at any disruptive event in the history of 16 years here. What does an investment banker do in Silicon Valley, and particularly for founders who probably think of you as Wolf of Wall Street,
Sure.
suits and ties at Goldman? What
Yeah.
goes on in your life?
Sure, yeah. So, no, obviously I don't have a suit. So, and just to echo a lot of what Jess and Justin had said, a lot of the work that I do, especially with companies, is help them start to think about exits much earlier. And again, this isn't put a for sale sign up on the company when you're a month old and actively shop the company around. But again, everyone's heard the adage, great companies are bought and not sold. But the corollary to that is you have to be known to these acquirers in order to be bought. And that happens with what Jess was saying, developing these relationships well in advance of an acquisition, whether it be to that acquirer or whether that be once someone does start to express some interest, then you can decide, is this the best possible outcome for you, both in terms of price and in terms of company. And so a lot of the work that I do in the upfront is helping companies to develop that sense of how do you reach out commercially, who should you be talking to, how should you be talking to them, how do you start to develop these relationships. And then as that starts to develop and as companies start to express some interest, to Justin's point earlier, how do you interact with them, right? Do you allow them to interview all of your employees? Do you allow them to, have free reign of all of your information out there? A lot of that is, the advice that I work with in companies, and how do you navigate through that in a way that, isn't disruptive to you and, helps to get them the information. And then all the way through the process of, helping to negotiate the transaction. And frankly, the most value that I provide is actually getting the deal done. And so that's what I do.
So I want to open up the floor to everyone here. So when you, as a startup founder, or as an investment banker advising founders, what is the responsibility for a founder to consider exit opportunities or to create them? Should they be doing that all the time? Should they be receiving any sort of inbound? Should they be ignoring it if they feel like everything is going right? What responsibility do they have?
Sure, I'll answer, and then maybe everyone else can add on to it. I would say, kind of similar to what Jess had said earlier, like a CEO's responsibility is, first and foremost, keeping the company alive and giving it options. And so just as much as you hear, that one of the core functions of a startup CEO is raising money and how you're always raising money until you're not raising money, it's the same way with exit opportunities, right? You should always be thinking about and developing these relationships well in advance of that. And again, the reason why is because you should be more in control of this. Hopefully this is an outcome it's a cake and eat it too type of scenario. This is a great partnership that we really want, and it's an acceleration of our vision, and it's the best price. And the only way that you'll know if it's the best company, and the only way they're going to be willing to pay the best price, is if you spent the time to get to know them. And so I would say 100% one of the founders' responsibilities is developing this. Now again, that's balanced against all of the other things that a CEO needs to do as well. But again, there should be a little piece of it that you do early on.
I think that in the beginning, your responsibility as a founder is to just find product market fit, work on your product. And then once you have a product that people want, you want to figure out how to get in the hands of more people. And that's when it starts to become really valuable to know everyone in your market and in adjacent markets. And at a certain point in your company, it is your responsibility to actually be out there talking to all the people who could be strategic partners for you, or distributors, or where there is some sort of a creative partnership. And those are generally the people who are going to turn into an acquisition. And so I like to think about it like you should be knowing those people, building relationships with them, thinking about what you could do with them, but not necessarily trying to sell your company.
And let me ask you, who drives the momentum around a sale? Let's say you're going through a process and you're like, Justin, like you said, you're desperate, I want to get something done. Who actually is going to get that all the way to a close? Is it the founders? Is it the investors? Is it investment bankers? Is it the corporate development officers? Who trying to drive towards a sale?
Usually it's not your investors. In my experience, I don't know, don't have that many data points, but I think it's really, you need a deal champion inside that company who really believes in, the accretive value of owning your company. And if you don't have that person, then it's really not going to get done. So really getting somebody at that company who's like, we need to buy this company because of X, Y, and Z reasons. It's really good for us. Hopefully that person's the CEO, but maybe it's another executive in the company. I think that's super important, and that's kind of a prerequisite to getting a deal done.
Yeah, I would also say it's interesting to sort of compare and contrast it with the fundraising process. With the fundraising process, as a founder, you're kind of pitching like, I'm a unique, special snowflake, and this is who I am, and this is what our company does, and here is the timeline for the fundraising, and you try to line things up schedule-wise so that you get an answer by a particular time. I would say with M&A, it is a lot less about you, and it's more about the acquirer, right? So I think at first, what I did was I made the mistake of going in and saying, I'm a unique special snowflake, and kind of reusing my same fundraising pitch. And I kind of realized over time, like, you have to fit into the strategic priorities of the acquirer. So then I started to do a little bit more homework, and I looked at each of the acquirers, and I thought, what is their strategy? Who's the right champion, to Justin's point, inside this company? And how do we actually fit as a strategic asset into this company? And then I started to change the pitch a little bit to be more about them and their strategy and where we fit in. And so it was still pitching the same company, but with like a slight twist on like the value prop, because it was slightly different for every company, for every acquirer. And I didn't control the timeline, right? Oftentimes M&A might be triggered by the acquirer maybe has known you over multiple years, you have that once-a-year coffee, and they're like, wow, we just decided to invest in gaming, and so what's out there, like, well, I've known Justin for the longest time, and it just sort of fits what we need right now, and it's like sort of an internal trigger more than an external one. So, it's their trigger, not necessarily yours. So I think it's very hard to just conjure an acquisition unless there's competitive dynamics. And oftentimes it's triggered by what's actually going on inside the acquirer. Yeah.
Yeah, no, I mean, I agree exactly with what was said. And again, spending the time with the acquirers is exactly for that point. It's to help understand how you best could fit into that, what you can help to accelerate, how they, how strategically important what you are doing is to them. And again, with multiple potential acquirers, right? Spend the time with them. And the way that I like to think about this is, first and foremost, as Justin said earlier, great companies, when they have a great outcome, it's because they were great companies. That's what you started with, right? And so first and foremost, like, focus on that. Focus on building a great company. But with that said, building relationships with these other outside potential acquirers, it can be a win-win, right? It could be a commercial relationship, or it could be an acquisition. And that's the way you should be thinking about it as well, right? This could be a future partner, whether this be an acquirer or not.
So many of you have worked on multiple sides of these tables. So you've been founders, investors, advisors, and sometimes there's tension in that relationship, right? Sometimes your investors want to sell and maybe cash out, the founders do not, or vice versa. Maybe the founders are sort of checking out and the investors want you to go farther. How do you sort of navigate differences of opinions, either between different investor classes or just from the tension on a board?
I've been in a number of situations where there have been, investors that have been pushing for a sale, or, they have a, time frame that they're trying to adhere to. What I've found out is, in general, that doesn't lead to a great outcome, right? Like, just because an investor wants to sell right now, as Jess mentioned earlier, you can't really control timing. So there could be a whole bunch of reasons for why now isn't right. It could be because we're too early and we haven't demonstrated product market fit. It could be because we don't have enough relationships here for them to know how to properly value us, a whole bunch of reasons. And so for that, what I think is a better way to navigate this is, again, it's great to be able to engage in those conversations and find out why. Because there's a bunch of other solutions that may solve that problem, right? An investor may have a fund that's ended 4 or 5 years ago and needs to get some liquidity. That doesn't necessarily mean the company needs to be sold, right? There's secondary transactions, there's other things that can be done to get that investor the liquidity that they need. But I think the best way to navigate through this, and again, whether that be investors or whether that be board members or founders or whatever it is, because sometimes there's founders that have difference of opinions, kind of amongst themselves. But talking it through and finding out, like, what are you really truly trying to, what's the problem here, and let's try to creatively solve it. I think that's the better way to handle it, rather than there's someone here that wants to sell the company, we need to sell this right now. And some investors I've seen that have been more aggressive around that, and that's never a good thing, right? Trying to do some things on their own without the, the rest of the company on board with it. And I like I said, I don't think that ever ends up in a good situation.
Either of you want to answer? If not, we'll...
I agree with that. 100% agree.
Yeah.
Let me move on. So this is also addressing one of the audience questions here. Your CEO, you know there's a sale process going on. The board's kind of committed. You're going through a process. Maybe there's an asshole like me who works at TechCrunch who's leaking data about what's going on in the sale process because we got something from Google or Yahoo. How do you handle employee questions about this? You're at a TLDR or whatever they call these TGIFs on Friday, and one of your employees goes, "Hey, are we being sold right now? Like, am I going to have a job next week?" Like, how do you think about leading through that sort of situation?
I tried to keep our acquisition process quiet. It's just very distracting for the team, and you have so little control over it. I'd be very transparent about pretty much everything else at my company. P&L, like cash runway, metrics, fundraising process. And the fundraising process is different is because you kind of control the timeline. For M&A, I kept it very, very quiet to a very limited number of people. And that was actually one of the hardest things for me personally, because I was so transparent with the team, and to suddenly be like mysteriously out of the office or sick at home when I was actually flying to New York or pitching somewhere. It was really, that was part of the hardest part of the process, was the not being able to be completely honest with the team. But I think you don't want to set up the team for some grand expectation. You just don't know what happens, right? It's just not done until it's done. It's like 50%. One of my mentors told me it's 50% probability until the money is in the bank, right? And so just believing that, it was really, I preferred not to share it with the team to get there. It was just too much of a distraction. If it was leaked, though, I think you have no choice but to be, I wouldn't recommend you lie to your team. So I think you just have to say, yeah, we are exploring some conversations, but who knows what will happen. It's, odds are never great in these conversations, and we should just keep, the most important thing is to build a great company. Yeah.
And I just add to that, it is an incredibly distracting process, as these two know. And so again, adding the additional layer of having employees who aren't fully aware of everything going on, it makes it even more distracting. And as Jess said, the deal's not done until it's done. And so to bring your team through these kind of fits and starts all the way along can be an incredibly jarring experience. And at the end of the day, we keep saying this over and over again, build a great company. Taking your team and saying, oh, we're not going to do this because we're going to get sold. Oh, wait, we're not going to get sold, so do this. Wait, we are going to get sold. Like, that's not the path towards building a great company. And so again, as painful as it is, and I've worked with a lot of CEOs who are similar to Jess, where you're completely open, this is one area where you're doing a benefit to all of your employees by keeping it, kind of a little bit more under wraps. Again, what I've found is once you do, employees are very understanding of, kind of what needs to happen there. And then once it is done, I'm sure Jess did this as well, you come clean and you say, hey, listen, this is what happened. I'm really sorry I wasn't sick that day, but this is what happened. And so again, it is a little bit more of a cathartic experience for the CEO as well, but
yeah. It
is incredibly distracting, and so managing that is key.
Justin, I want to ask you, you've coached a lot of founders, obviously, through Y Combinator, I'm sure today as an angel as well. How do you address exit opportunities in a fundraise? Is that something that founders at the seed or the A or the B, should they be addressing that in those conversations, either what they personally want or maybe the potential opportunity in a company?
I think the thing that we always do at YC, and really I would say is true, what I tell people today, is just like at the seed stage, A stage, you don't really want to be thinking about that, and I don't think you really want to be talking about that with potential investors, because I do think that's an adverse signal, whether it's true or not, that you want to, we would sell the company for whatever, $50 million. I don't think that's inspiring to investors who want to believe anyways that you want much larger outcomes. So I think it's really, you should just focus on building a good company at that early stage. That's the number one thing you need to do.
This might sound odd coming from an investment banker, but everyone knows I'm a different type of investment banker. I don't believe companies should ever actively be looking for an acquirer, right? Like, you should be actively working on building a great company. Now, that said, you should be opportunistic in how you think about this. You should build the relationships as we talked about before. You should try to maximize the outcome as it comes. But as Justin said, kind of, especially in the early days, you're going to create substantially more value by creating a great company than you are by looking for someone to acquire you at that stage.
And even actually at the later stages, when I've been, in seed stage companies or companies that raise a lot and have a real product, and they've always said, oh, maybe I should check the market and see if I can get an acquisition versus like what our next fundraising round would be at. Those acquisitions, talks that they try to generate, I've never seen that work in that way when they're trying to run it concurrent with a fundraising process super well.
Agree.
So one of the questions from the audience, how do you know when it's the right time to sell? Like, is there a moment in each of your companies, and particularly for Jess and Justin, when you were like, nope, this is definitely, like, we're done, and we need to like find a way to exit?
There's 9 zeros.
So when the number gets big.
Yeah.
I mean, I think it's always the, again, this is where there's no kind of concrete answer. This is why, like, if this was easy, then everybody would be a CEO, everybody would, have a startup. At the end of the day, you're always trading off, kind of the risk reward that, and again, hopefully in an acquisition, this isn't a, we're done, we don't want to do this anymore. Hopefully this is a great outcome where it's an acceleration of the vision that you wanted to build from the beginning. Hopefully that's what occurs. And at some point in time, you meet the right acquirer, right? You meet the right, you've developed the right fundamentals of the business and the price is right. And you look at, okay, what's the value that I could create on my own versus partnering with someone that gets me the scale of a sales force, or gets me the scale of distribution, or gets me the scale somewhere else. And I accelerate this vision, okay, now is the time, right? Those numbers are lining up. The trajectory of what I can do and the acceleration that I can get through a partner is right. It's kind of similar to, when's the right time to find your spouse? It's very similar, right? It's not, there's no kind of formula for X, Y, and Z, and here's your spouse. It's much more, when is the timing right, and what does this feel like for you?
So Jess, go for it, yeah.
So I'll just say what happened with us. We were about, I think, 7.5 years into the journey, and I had a team that had like come really far along that journey with me, and I felt like, oh my God, some of these people have been with me for so long, and I just really owe them. And for us, what had started to happen was we were in the middle of the desktop to mobile shift, and we'd built a great business on the desktop platform, and we were not having as much success on mobile. And so I could see that at some point we needed to like reinvent ourselves for mobile. And I thought, all right, reinventing ourselves for mobile, we'd have to change the product, we'd have to do a lot of different things. We'd tried multiple things and it hadn't yet been clicking. And so I was like, all right, we are back to the early seed product market fit hunting stage in mobile for our business. And that, I know from experience, could take anywhere from like 1 to 4 years. And I thought about, okay, do I have the energy to do that? And does this team have the energy to do that? And are we willing to take the risk of continuing to go on in this state? And as I was thinking through that, honestly, 2 acquirers reached out in the same week. And I was like, maybe this is a sign. And so then I started to pull the trigger and like talk to more and more of the acquirers. But for me, it was a lot of the decision came down to like, what's the right thing to do for this team here? I thought about, will they stay through having to like pivot our way into a brand new mobile app or not? And what do I owe the team? And so honestly, that's how I thought about it.
A little less facetious answer on my part is I think that you really want to put yourself in the headspace where you can make a rational decision. And I think that lots of I've been there myself both times, on our acquisitions, well, all the ones I've been part of, but then also with a lot of founders I've advised where they're burned out or tired, you want to do something different, and I think so they think like, okay, I'm gonna sell my company and then like everything will be better then. And I think the actual answer for founders is really to try to create an equilibrium in there, because you don't really control when an outcome is going to happen at any given time, even if you want it to or you're burned out. You want to create a situation where you are okay with what is going on, like in your company, like running your company every day, and you're not like desperately seeking something else, like some sort of like acquirer to come deliver you from your present day sorrows. And I think that too many founders are like looking for, they really think of this acquisition as like, okay, it's just something that's going to happen that's going to save me, whereas really what they should be focused on is getting right with their like every day at their company and being more at peace with what's going on in their company. And like accepting kind of what's happening. I think that's That's something I wish, so that when they do have someone coming and saying, hey, I want to buy your company, they can make a rational decision, not like, oh, I'm tired, yes.
So when each of you, including Mike, what are the factors that go into selecting? You went through this process, and I'm addressing an audience question here. You have a couple of different suitors, maybe a couple of different options, different prices, different maybe quality of companies, maybe a couple of different other kinds of terms. Like when you were thinking about how to exit, what was sort of the criteria that you were looking for in selecting between offers, or the one offer that might have gotten there?
I didn't have a ton of options. I mean, so my situation, we exited for in the hundreds. We had tens of millions of dollars in revenue, and it was hundreds of millions of dollars acquisition. So not like a massive strategic billion-dollar Twitch sort of situation, and those tend to move quickly. Or, I don't know if this was true for you, but.
Well, we tried to sub 3 times. It took like 6 months, so not really. But
oh, okay.
for us,
they
kept falling up. They kept falling through.
Oh, interesting. Yeah. For us, it took 9 months, and different suitors came and went, and it was a little bit of a song and dance, or to like kind of create an auction almost to make that happen. For me, what I thought about was a few things. One, is this actually a strategic fit for what's going to happen with the product? And then, will the team and I be happy here? Because the acquisition isn't like it's done and you walk away. It's like for most founders, it's the beginning of another chapter, right? And the chapter after that is integration. And so I cared a lot about whether we would go to a happy home, essentially. Mm-hmm. That was important to me.
And Mike, you obviously a lot of deals, 6 months, 9 months. What do you see in your data in terms of how long the process takes and the integration time?
Yeah, so before I answer that question, I'll just kind of add on to Jess's as well. Like, again, starting to think about who potential acquirers might be, developing those relations, that's all about optionality, right? So that when you are at that time of when you do decide that you did want to sell or you did get an inbound interest, that you do have more options to think through, who would be the best fit. Like Jess said, there's a lot of times, a majority of the times, of when you don't have those choices. And so it's more of an evaluation of, do I want to do this deal or not? It's not, I'm trading off 5 or 6 different offers or 5 or 6 different companies. So again, building on that optionality. But to answer your question, the upfront, that kind of courting process, again, it's hard to say like how long that could take. That could be a month, that could be 3 years, that could be 4 years. It's however long that you develop a relationship. From the point in time that you actually are talking numbers and have an offer, it's usually anywhere from, it's elongating a little bit. Historically, it's been kind of 30 to 60 days. Now it's kind of more 45 to 90 days, I'd say, kind of in there. But it's something like that. And a lot of it is tied to, again, this is getting a little more technical, but once you agree on a deal, you go into exclusive conversations with that acquirer. And that period of time, miraculously, is usually the time for what it takes to do a deal as well. And so again, like upfront, what you're negotiating on that time frame is usually what it takes to get the deal done.
So for Jess, this is another audience question. How has exiting changed the way you approach investing at Sequoia?
One thing some of the advice that I give to the early stage founders that I work with at the seed and Series A stage is just one of the big lessons for me was how valuation actually works once you move into a stage where you're exiting, right? Like, I think there's a lot of pressure to pump up your valuation and make it really big, but really valuations are just, at the private stage with private investors and VCs, it's just kind of funny money. Like, it's monopoly money, it's a made up number. When you either go IPO or exit, like some corp dev person is probably doing a cash flow analysis and looking at like—
I would hope.
Yeah, or looking at like using math, right? Taking your revenue and thinking about a multiple of revenue and thinking about your free cash flow, all of that. And so I never thought as much about that kind of math when I was fundraising, right? And luckily we never raised, we're a very capital efficient company. We were all software, we didn't need to raise much money. And so what ended up happening was I realized at that time, at the moment of acquisition, that we needed to clear a particular valuation hurdle, right, in order for everyone to make money. And so I never had thought about it that way. My valuation is like my price ceiling, essentially, or my price floor. And I think there's this culture in Silicon Valley of like, oh yeah, I raised so much money, that's so great, or like I have such a high valuation. Like all of that is like funny money. All that matters is like the last, like the valuation at the exit time. And so being capital efficient, like thinking about a rational valuation, like those things I think actually matter. Like you have to build a fundamentally sound business. And I hadn't thought about that enough until the moment of M&A. So that's something that I think about with and try to teach the founders that I work with, because I lived through it. And I got lucky, right? Like we all did very, very well because we hadn't raised a crap ton of money and we had a valuation that was lower than the M&A price. So, yeah.
Mike, do you see this with a lot of your clients that, high valuations, or that there's a challenge in the acquisition or IPO process around valuation?
Definitely. I mean, it's like Jess said, it is a little bit, it's, the valuation, just as valuations can go up with private companies, they can go down, right? And as long as the clock is still running, it can go up and it can go down. I've seen a lot of companies that have gone up and come down and that's it. I've seen a lot of companies that have gone up and gone down and then come back up again. So again, you never know, it's still going. But in the end, it's when the clock goes out of when your company is bought, right? Now again, hopefully that's not the end of the life of the company, because now it just goes into a new life in combination with another larger entity. But for the investors, for the employees, as far as liquidation, that's it, that's the end of it. And yes, there are a lot of times of when, for whatever reason along the way, maybe it was because there was demand initially that propped up a valuation that then beget another propped up valuation that beget another propped up valuation, that in the end, when it comes time for that last kind of, okay, here's where we're at, they don't line up, right? They don't line up with the fundamentals of the business, the monetization that you needed to have, the number of users that you needed to have, X and X, based on that valuation. That's great that your last round was that, but now here you are, and we're paying real money for this business. It's not worth that right now, right? And so there is a lot of times of when that comes into issues. And I've seen a lot of times, I mean, again, sometimes you get ahead of it and it doesn't prevent the deal from happening, and sometimes you don't, and it does prevent a deal from happening.
And Justin, this isn't your first rodeo. I mean, you just launched Atrium. How are things different this time around? I mean, are you thinking about valuation, exits, investments differently this time than you did in your earlier projects?
Well, I think I'm not really thinking about exits. I mean, at this particular company, I think it's really hard to exit, actually. So, my goal was to build a really big company. Felt like it was a good opportunity. I'm solving my own problem as a founder who had to deal with a lot of legal. And so it was really more about, like, can we build a good company, build a good product? I don't think there's, we didn't really start it with, like, exits in mind.
So let me ask you, I mean, for Jess and Justin, you exited 2 companies. What's it like to make the transition from being a founder into a company? Because there's multiple questions from the audience. I think a lot of people are afraid to, okay, I was an independent entrepreneur, you have 20, 30 employees, it's super fast, and now you join a big corporate conglomerate and everything's going to be super slow. Like, how was the transition for you?
Well, my friends all are jealous. They always say, I'm like, I need to do what you're doing, because I've never gone with the companies. I've sold a couple, and I've tried to sell a lot of times, like 50, more than twice, right? So it is that 50% success rate. But I've never had to go. I always had, like, one of my other co-founders become the CEO, and or so it just always kind of worked out that way for me. So I don't know. Mm-hmm. Sounds like it could be tough.
For me, I stayed at Yahoo for, I think, about 14 months after we were acquired. And what's funny is yes, there was more bureaucracy and red tape, and I didn't control, things that I cared about, like our culture or the promotion process or being able to, like, reward people the exact same way as before. So it definitely was a transition. But I found that my, like, stress level, like, totally went down, right? The existential stress of being a founder, stuff like that, yeah. But just the existential stress of, like, are we going to live or die, right? As a company, like, these 100, whatever, 30 people followed me, like, is it going to be okay? Like that existential stress went away. And so Yahoo treated us actually very, very well. And we got to ship a bunch of products once we landed inside of the greater fashion lifestyle portfolio there. They treated us really well. I found my stress level dropped, and then for our team, their stress level went up because I could no longer control like some of the things that they were used to me controlling, so they had to deal with more red tape. So interestingly, I became like much more chill, and then everyone else became less chill. Yeah.
And Mike, from your clients, I mean, do they both? What kind of percentage do you see going with the company versus not going with the company? And is that important to acquirers?
Again, it depends. I've done some deals where I think what's very important is that you're clear up front, right? It's hopefully nothing that's halfway through the diligence conversations. Hey, by the way, the CEO is not going to come with the company, right? Or the CTO is not going to come with the company, or some important member of the team is not going to come with the company. That can definitely be problematic. But there's been a lot of deals that I've done of where it's known, right? This person is not going to be coming with the company for whatever reason. There's a whole host of reasons for why not. But again, as long as that's clearly articulated up front, then it's not a problem. I haven't seen that be an issue. It's when it becomes an issue is when it's a surprise. Oh, we really thought and we really placed a lot of value on her or him or whoever. And that's really where it becomes problematic.
So a question from the audience, there's been a rise of a lot of these PE firms coming in, buying out companies. Vista Equity, a couple others go in, particularly in the SaaS category, but also others. I mean, are selling to them different than selling to a corporate acquirer, or are the factors that they're looking for sort of the same?
I'd say, and again, you are right, we are seeing more of these private equity buyers that are coming into the space. And I would say it's not that private equity is new to acquisitions, it's new, at least in the space in the companies that I work with, because we just typically didn't sell to them because they weren't strategic acquirers. They wouldn't pay strategic value prices. We are seeing that more now. There are private equity companies that are paying strategic value. More often than not, it's because it's a portfolio company of theirs that's making the acquisition, and so it's kind of that same theme of a rise of private-to-private deals, right? We're seeing a lot more of those that we had never seen before. I will say it's completely different negotiating with a private equity buyer than a strategic buyer for a whole host of reasons, but it is different and it is unique, but we are starting to see that more.
Mm-hmm. I'm going to end up with Jess and Justin. You're both a couple of years out from your exits. The companies have had different courses. Twitch is out there a couple of years. You've seen Polyvore have to shut down. How do you feel about the exit longitudinally? It's been a couple of years. Mm-hmm. Like, do you feel good about where everything ended up? Do you feel bad about it? Would you have done things differently in hindsight?
I think that Amazon has been an incredibly good home for Twitch. My co-founder Emmett is still CEO and he runs it. He's been running for the last. It's almost the 5th year anniversary night, I think, 2014, right? So yeah, so it's been 5 years, and I think he really likes it. Speaking about where do you want to, who's a good acquirer? I think someplace where you can learn, right? Where you feel like you can continue learning is really good, and I think he's learned a lot at Amazon, and they've continued to fund the business, support the business, and leave it relatively alone. And so I think it's been pretty incredible. I mean, the site has grown a lot, and since it's been in Amazon, they've continued to be very supportive. So I couldn't imagine a better home. We actually tried to sell it to like other companies, other giant companies that probably would not have been as good of a home, And so I'm very thankful that it ended up there.
In our situation, we were acquired by Yahoo. It was a good home, but then Yahoo got acquired by AOL, and then AOL got acquired by Verizon. So
tell me about it.
Yeah, you're living through that too. And we just kind of lost control of where things ended up. I ended up leaving, and then Verizon, or maybe it was AOL, I can't remember which, started selling off the different assets or shutting them down. And so Polyvore was one of the casualties and got shut down, which is totally heartbreaking. I got a lot of really unhappy users writing to me from our community the day that happened. But such is the life cycle of things, especially in consumer, right? Most consumer products don't last. I think we had a pretty good 11-year run, and I don't regret it at all, because when I look, the thing that actually matters, I think, was, to me, the team. And I know the team did well, and it was life-changing for many of them. And I still, like, I'll always remember, like, the day we announced, it was just, like, really, really special. I was so worried. I thought that they would be really mad that we were selling for the amount we were versus the, it was supposed to be Silicon Valley, billions of dollars exit. And so I was really worried, and I just didn't know how the team would react. And so I printed out these, like, little sheets of paper for each person, describing, like, exactly how much it would be worth to each person, and then I put in a little envelope, and I put a handwritten note on, like, every single one of those envelopes for about 125 people. And I remember we announced, and everyone just started cheering, and I was blown away. I think I started crying immediately because I was just so shocked, and, like, this relief feeling. It was just a really weird mix of emotions. And then the team was celebrating, and that was, like, such a great day to know that we had been one of the companies that made it, right? Because 90% of startups just don't work out, just go to zero. And so anyway, what I think matters to me most is, like, that team and taking care of them. And yeah, it was a great day. I don't regret it at all.
Thank you so much. A huge round of applause for our panelists. Thank you so much for joining us. And